Hello everyone and welcome back again to year 2 of Ventures. And year 2 it's essentially season 2, where I'm going to be mixing in more episodes on one particular topic, providing my own commentary and clips from previous episodes to give you a better understanding of one particular topic of many that we talk about on this show. So today's episode is all about how to start a business, specifically how to take your idea and put it to action to determine whether there are actual customers and users that actually want to interact with the product or service that you're trying to bring to life. And so I'm going to be mixing in some episodes. If you're watching, you can also listen by searching for Ventures in your podcast app. Anywhere that you listen to your podcasts, you should be able to search for Ventures and find this show. And if you're listening, you can also watch by visiting wclittle.com, and there I'll have more extensive show notes to the topic today about how to start a business. So with that, I'm going to just dive right in. Thanks for watching, thanks for listening, and let's go. So I've noticed, working with startups the last 15 years or so, that there's a characteristic of a founder that would say that they have a product vision and they're just going to carve out a market, whether people like it or not. And they always point to Steve Jobs and the iPhone, and they're just like, this is what the people want. And then there's the people who read Eric's material and think, I just need to measure everything. And based on data, I'm going to move my product feature and product roadmap on XYZ. And as my background's in science, I spent the better part of a decade in a bioengineering lab. So I take data and statistics very seriously because it was a matter of graduating or not graduating for me. Right. So I still have, it's still sort of triggering for me, all things statistics and data, especially when it's not done well. So I'm a little bit of it's a pet peeve of mine when people do statistics haphazardly. So I'm always cautious when I work with founders of, are they actually just optimizing for a local maxima, right? Are they collecting data based on a relatively low number of data points and making decisions about their products that are actually leading them in a direction where there's a much larger market and a much larger opportunity over here, but they miss it? So how do you advise and how do you think about the dance between product vision and pivoting based on data?
Yeah, it's interesting. They've done a bunch of stuff in the emerging markets in MENA, and I'm starting to do some stuff in sub-Saharan Africa. And one of the consistent trends, Will, is that people will think about, like I remember doing a startup weekend in Moldova, right? And people think about their total addressable market as Moldova. And I'm like, whoa, what do you mean Moldova? Like, how about the rest of Central Europe, and how about all of Europe, and how about the globe? And right. I think founders tend to think about the markets they're in, which is super interesting. In the US, we have a big market. But if you're in a niche market like Egypt, the answer is I've got to think about Egypt and the GCC. But let me come back a little bit back to the data set. If I look at the unicorn list from CB Insights over the 400 unicorns over the last 3 years, right? Almost all of them have something in common, that it doesn't lead with product first, it leads with total addressable market first, and what I would call a nascent market. So most of the big players have gone after a category that didn't exist as a billion-dollar market when they started. It may be a multi-billion-dollar market today, but when they started, it wasn't a multi-billion-dollar market. Mm. So a very consistent trend there is that market matters more than product. So, and what I mean by that is that a great team in a crappy market is going to produce bad results, right? So my analogy is a wave, right? If you want to go to the north coast of Hawaii and ride a big wave, the answer is the product needs to be right, the surfboard, and the timing needs to be right, or you're going to be waiting a long time. Mm. Now, if you want to go to the south coast of Hawaii and ride a wave, it may be 3 feet, right? So there's nothing super exciting about that one. Investors will look at it and say like, eh. So my point is a great team with a great product in a super tiny wave are going to get really marginal results. They'll get crushed from an investor perspective because there's no outcome. And if they're truly, the self-proclaimed visionaries you find on LinkedIn, then it could be 3 years before the product is actually ready. And I'll tell you, that's super expensive because right. you're trying to train the market, and you're like, you don't have enough money to train the market. So So I think market comes first is my observation. I used to say team comes first. I've kept the blog up to just institutionalize and not have revisionist history.
Right.
But today I'm definitely under the opinion that market comes first, and timing and market together make a huge difference. So I'm glad you have a product vision. That's awesome. It should be informed by data, which is customer interviews. And hopefully you do have a really transformative product at the end. But keep in mind, think of this as I have launch and I have scale. A lot of founders live their life as if they're in scale today. But I'm really just trying to get them from launch and survive this, the terror part down here before you hit the hockey stick, and compress the time it takes to get to the hockey stick, right? Because that time is going to exist. And if you don't have enough budget, you'll just die, right? Which is why the math is the way it is. So keep the product vision, but also look at my reality of what can I ship in the time frame I have, with the engineering talent I have, with the budget I have. And you'll keep iterating on that as you go and get to the hockey stick is the goal. But keep in mind, you have to survive long enough to get to the hockey stick, which is where founders kind of, I think, especially first-time founders, are a little bit naive. They're like, oh, I didn't have enough personal runway. Should I go raise money? And it's like, well, if you don't have any traction, you're not going to raise money these days.
Yeah. I really like the analogy of pick the side of the island that you're going to surf in, right? Do your homework on your market. Pick a market. Yeah, no, that's good. And I think even to extend the surfing analogy even more, so you find the side of the island you're going to surf in, and you build a product, you got your surfboard, you're riding this wave, and maybe the how to pivot your product is almost like which way you go. Like for those who have surfed, if you go this way, sometimes the wave is amazing and you have a nice long run, and if you go this way, it'll collapse on you or the wave falls apart or something. So how do you advise founders when they're on that wave, the wave is going, how do they know whether to turn right or left? Like, how do you actually use data to inform your product roadmap and to inform your growth roadmap?
Yeah, I'll switch analogies with you a little bit, because I think it's really it's all about training.
Yeah.
Right. So as you start to do customer development interviews, one of the things I outline in the book is a process to capture that customer data and capture email addresses and capture who said that they would buy it if you had this feature. Now, if you only do 5 customer interviews, you can remember all of them. Well, technically you can't, but you feel like you can. But when you do 50 or 100 customer interviews, you definitely can't remember all of them.
Yeah.
And let's face it, if you and I had a product idea today, and we had a list of 300 people who were interested in this particular product, man, our time to ship a product that group had consensus on would be so fast, right? Most founders don't have that list of 300. So you're going to start this month. I'm going to start doing interviews. And the last question I'm going to ask is I'm going to ask, hey, well, can I put you on my monthly email update for our progress? And almost everybody will say yes. And the ones who say no, frankly, were never interested in the first place, and you don't want them there.
Right.
But in a year, you're going to have 300 people on that list, or hopefully, at least 200 people on that list.
Right.
Who, when you send out a monthly update, you're going to say, here's what we shipped this month, here's what we're going to ship next month, and here's where I could use your help.
Yeah.
Now, that email should take you about 20 minutes to craft. That's it. And you should send it out regularly on the first or fourth or whatever day of the month. Now, most people aren't going to respond to you, but the people who do respond to you are going to become your super fans, right? And they're going to be like, oh, that feature's awesome. Like, if you added this, I would buy it. But again, if you don't track the data, it won't matter, right? You'll be like, I'm convinced that everybody wants a black car, right? And that's really not what you're building. What you're building is for early adopters, people who can be fans. And again, you're building for I have an ICP, ideal customer profile, at launch that's different than my ICP at scale. But I have to sell it to those customers. And in the book, I outline the concept of launch addressable market, right? Versus I got this abstraction, which is pretty academic, called TAM and SAM and SOM. And I try to connect that to your first 10, 100, 1,000 customers as your launch addressable market. It's like at the first 10, you and I as co-founders are going to go sell them ourselves. At 100, we're probably going to have a salesperson.
Yeah.
And at 1,000, we're definitely going to have a sales team. But until you and I can sell the first 10, the answer is we don't know. And that's really about how do I connect that abstract concept of TAM with my go-to-market strategy of 10, 100, 1,000.
What advice did you have for somebody who has the day job and they have an idea? right? Maybe let's say it's for a software company, a software product like a web or mobile. What advice do you have from them when they're thinking about it, they're stewing on it? How do you advise that hypothetical person to take the next steps?
Yeah, so I love the jobs to be done framework. If you guys, for those of you who don't know about jobs to be done, if you go to YouTube and you just Google Clayton Christensen milkshake, that's all I'm going to give you, Clayton Christensen milkshake, and watch a 4-minute video, it will all become clear. Clayton Christensen was kind of the grandfather of jobs to be done, and it's a great short little 4-minute video, and if you like that, you'll end up going down rabbit holes of and getting lots more information on jobs to be done. But it's really critical that you understand what problem you are solving and for whom. And I use that jobs to be done framework all the time, whether I do it formally or informally. And then once you understand it, then it's incumbent upon you to try to figure out how can you test this thesis about the job to be done as quickly and inexpensively as possible. And it doesn't have to be writing, a huge set of software and completing the whole task. And it can be mock-ups. It can be, there are paper versions, there's service versions. I mean, even back, I didn't know what jobs to be done was at Sure Payroll. The lean startup hadn't been written. This is 10 years before the lean startup was written, but we actually did a bunch of this. We had this thesis that people would want to do payroll on the internet, but we didn't know. So what did we do? Our MVP, our minimally viable product, was to put up a series of web pages that people signed into in security and all that stuff and entered their information. And then they hit submit and they got a little text box that said, oh, we're processing your payroll. We'll email you as soon as it's ready. Email you as soon as it's ready. That's because a human had to go and pull the data off of the server that had just been saved, manually put it into a known payroll engine that would process the payroll, do all the reports, do all the ACH, and then take the results, copy and paste that back into the database on the web server and hit a button and you'd get an email saying your payroll's ready, and you'd come and look at it and be all happy that everybody paid, hopefully, etc. But we didn't spend the money and the time to automate the hard part of the machine of the process. We had humans do things that do not scale, right? And in the early days, the person who was our payroll manager, I remember her coming in one week and saying, I have 10 payrolls to process today. Stay out of my way. Like, she knew she had 10 companies that were going to submit their payroll and expect their answers. And that was like overwhelming to her. Today, I don't know how many companies Sure Payroll has, but I'm guessing that this Friday we're going to process 30,000,
Right.
and no humans will touch any of it,
Right.
right? It all happens automatically. And we got there. We got up to 20, 30 companies that were customers before we had automated a bunch of those processes. But so you do things that don't scale. So what your goal is you have an idea. And then the next step is to have clarity around who is your customer and what problem are you solving for them. That's the jobs to be done portion. And if you have clarity around what the problem is and how you're solving it for them, then you try to create the minimally viable product, the least amount of work you can do to test whether or not this customers are going to want this problem solved for them. And many times that can be done with manual processes and things that aren't nearly as fancy. You're not testing for gross margin, efficiency, any of that. We're just testing, are the customers going to want this thing? Going back to, again, I think the most important thing for success is being able to acquire and retain customers. Do the customers really care? And if you read the Lean Startup, you'll see about smokescreen tests and about Wizard of Oz tests. And those are the sorts of things you can do on the web really cheaply and quickly to determine that. You put up a page that looks like they're about to buy something. They think they're going to buy it. They might even type in their credit card number thinking they're buying it. And then you say, oh, sorry, we actually aren't shipping yet. But you got real data from real customers about the value prop, and you can A/B test different value props. You can put up one page that is touting the features, one that's touting the benefits, and you can see how differently, what different rates people click through. But you have to get to the point where you have some evidence that real humans want this problem solved and are willing to pay for it. And that's when you can then start thinking about investing real time and money into building software and building customer products, et cetera, et cetera.
So roughly speaking, in the software world, there's essentially consumer facing products and marketplaces and business to business software. Are those three rough buckets accurate, or would you? And I know there's sort of hybrids in between the three of those. But how do you think about the landscape of software companies thematically?
Yeah, that's true. We have a couple that are B2B to C,
Yeah.
um, that are kind of hybrids as well. But I think that's right. We generally bucket stuff, and yeah, and so we generally bucket stuff B2C, marketplaces, B2B.
Okay.
Uh,
And how? So for each of those, just those three, roughly speaking, how would someone who has the idea, they're out there running lean startups, running the tests, how would someone think about whether? And this I get this question a lot, and I'm sure you do too. How do you know when it's quote unquote validated? How do you? I know it's a little bit of an art form, but how would you advise people to think about? Okay, I have something here. This is worth investing more of my own time and money, and then we'll get to later when we should think about approaching investors. But I'm curious about the question of validation in those rough three
yep.
buckets.
So entrepreneurs always, many times come to me with questions like this. They want an answer. They
Right.
want a single number.
Right.
They want something that's truth. And the reality is it's much more art than science. And it depends. And I know you're not going to like my answer when I say it depends, but it depends. It depends on, are you selling a product that costs 99 cents? In which case I might want to see thousands of sales before I'm convinced. Sell this chapstick 2,000 times, and then maybe I'll be convinced that there's a market for it. It's only $2,000 worth of sales. Are you selling a product like a new computer that costs $2,000 per item? Right? You don't have to sell 2,000 of those to convince me people want them. So it depends on price. It depends on how considered a purchase it is. Um, what I'm generally looking for in the early stages is early signs that the customers love the thing that you have, and that usually is engagement metrics,
Mm.
right? And
Yeah.
so I'm looking for, I don't know, I'll pick on this lip balm. If it were some sort of electronic lip balm, it's interesting that people buy it, but I really want to know, how often do people actually use it,
Mm.
right? Because if I had early data, if I only had a couple dozen users, but I saw that the people who bought it used it 3 times a day religiously, every single one of them used it at least 3 times a day, there's incredible engagement. I have confidence that this thing is going to be great, right? Um, and so those engagement metrics are really important. I have a current but short story that might help shed some light on this. You all know what Peloton is. It's this fairly expensive indoor exercise bike that comes with a screen and interactive classes. And a friend of mine posted something on Twitter and said, "Hey, I'm thinking about buying a Peloton. I'd love some feedback. What do you guys think?" And you basically got a bunch of people who said, "I have one. It's awesome. I'm in the best shape I've ever been in. I work out more than I ever have. I love it, blah, blah, blah." And a bunch of people said, "Totally not worth the money. You should, get a Schwinn bike for a quarter of the price. And if you really want to, get an iPad and put a video up there."
Right.
And what was interesting about that was the people who said it's not worth it were 100% people who had not owned one. And
Mm.
the people who had owned one were 100% said, "It's amazing. I love it."
Mm.
And so I reframed the question and put it out there. And as background, you should know I'm an avid cyclist. I actually do have a Peloton as well. But and so it's a little near and dear to my heart. So I put it out there and I said, only for those people who have owned a Peloton,
Mm.
what advice would you give to someone who doesn't want to ride on the streets, blah blah blah, should he buy, and can afford it, should he buy a Peloton? And 100% of the people who actually owned a Peloton and answered said, "I love it. You should get one. It's changed my life."
Wow.
Of course, there were 2 people who piped in who didn't actually own one and wanted to give their opinion anyway.
It's
But
Twitter.
the
Yeah.
reason I bring that one up is we all have probably heard how Peloton stock has gone up and how they've done well in the pandemic and all this stuff. But the early indications are, when you sample people who actually own one, very few people use them as clothes racks. Like, exercise equipment in general gets used for like 3 weeks and then sits and people hang their clothes on it to dry. And like, it's right, and it sits in the basement and gathers dust. And for some reason, they have some magic between the interactivity, the screen, the bike is well done, that people who own them generally use them and use them regularly, every day, every other day. Count how many classes they've done. In the people who responded to my Twitter feed, I can't tell you how many people said things like, oh, I bought one in March, I've done 187 classes on it.
Wow.
187, like they're counting. Well, Peloton gives you that data, right? Um, and uh, and so seeing that, if I had seen that early interactivity, that early engagement, that would have given me confidence to invest in that company, even long before it had the big numbers. Those are early indications of the big numbers.
That's gold. That's gold. Okay, so now let's say a founder is at that point where they feel like, okay, we got great engagement, or some early traction sales, depending on kind of their business model and the price and all the nuances that you talked about. How do you go about actually building it? How do you go about, all right, I need a team, I have a little bit of money, or maybe I need to raise a little bit of money. The actual execution of, I need to build this software product, because there are, and I'm sure you're aware of, tons of skeleton, tons of dead bodies, tons of graveyard stories of the process of actually executing at this phase. What kind of advice would you have for entrepreneurs that are there?
Yeah, I really, really, really prefer teams where there is someone with technical um, prowess
Yeah.
as part of the founding team. And that doesn't mean that person necessarily has to be able to code every line of code of it, but like even at Sure Payroll. So I was an engineer undergrad, a mechanical engineer, but I picked up software. I had a minor in software, but that was easy. And I coded. So the first company for those 11 years, 6 years by myself, and 6 years is our company, and then 5 years earnout. Those 11 years, I was kind of the lead go-to person for technology problems, and I wasn't doing a ton of coding at the end, but I still got the tough problems, and I love solving problems. But ever since then, in subsequent companies, I haven't really done any development. I did a little bit of the architecture at Sure Payroll, but I didn't write a line of code. But because I have enough experience with understanding how databases work, how architecture works, how the core technology works, how APIs work, et cetera, I feel like I have a command of what can be done and what can't be done, and roughly what things are going to cost and what they're not. I could look at a software spec and be like, yeah, that feels like 2 man months worth of work, or that's 6 people months worth of work, whatever. I'm not exactly right, but I have an idea. I know what it's going to take to build, and that puts me in a better position. Um, Even if I'm hiring developers, or even if I hired outsourced, I prefer to see teams, most development done by the actual team itself. Um, I want the people who are building it to know they're going to be responsible for supporting it, and that they have some upside in it. And so my first piece of advice would be, if you don't have that technical expertise, to find a co-founder who does. It's really hard. The good people are paid a lot of money by the big companies.
Right.
They're not going to give away their huge salaries to just come work on some idea for you. So you have to find someone who's passionate about your idea and has that technical capability. Now, the lens is getting narrower. It's getting harder to find them. The target's getting narrower. But if you can, it's amazing how much can get done. And when I was running Techstars, we would only accept teams in Chicago, when I was running it, that had core technology as a core competency.
Yeah.
And the way I told it to people, I said, listen, we have a limited time. We only have 90 days in Techstars. You're going to go meet with a whole bunch of mentors. You're going to come out of some mentor meeting and be like, oh my God, we want to test this thing. And what I want you to do is be, oh my God, we got to test this thing. Well, you know what? You make the coffee. I'm going to order the pizza. We'll pull an all-nighter. We'll get this thing done.
Totally.
Or I got to go home and I'm going to have dinner with the kids, but I'm going to stay up after that and I'm going to be coding, and we'll have a sample in the morning. Like,
Right.
whatever it takes to get it done.
Right.
What I don't want is to come out of that meeting and be like, oh, we got this great idea. I got to call the developer and see how much the estimate's going to be, how much it's going to cost, and when they can put it in their queue, because maybe they can get it done 3 weeks from now or 6 weeks from now,
Right.
because they have other clients, they have other priorities. And if it's so hard to start a business, and you need to be able to test things quickly, and you need to be able to iterate quickly, and so you need to have that capability on hand. Now, there were a couple companies that went through Techstars where they actually had an outsourced developer, but what they did was the deal was that person sat in the Techstars office right next to the founders 40 hours a week for those 90 days.
Right.
That worked. I still would prefer it to be someone who has a financial incentive in the form of, owning stock or options and has upside in the company, but that was acceptable. But you have to be able to respond quickly. You have to be able to pivot quickly.
Yeah.
And so if you don't have those skills yourself, I think you really should try to find a co-founder who does.
So then the common question, how on earth, what advice do you have for people, the classic question, how do you find a technical co-founder?
Yeah. So I think this is, it's a problem. It's difficult. Um, it's very much about the position you put yourself in. So if you think you're going to be starting a technology company or a company based in software, you should be, that's much harder in a time of pandemic, but we'll talk about normal times. In normal times, you should be going to some of these meetups, you should be going to happy hours, etc., and starting to build a network of people who are like-minded, people who are working on projects like you're working on. There will be business people and software people and support people. There'll be all kinds of people there. But like here in Chicago at 1871, they had all kinds of events. In Chicago, every single day of the week, there was an event you could go to. Some would be more fruitful than others. Think of it kind of like Give First in that, I said there's no specific expectation or return. You're not going to go to one of these meetings or go hear someone speak and be like, I'm going to find my developer tonight. But I know if you go and meet enough people and talk about your idea and what you're doing, you're going to find some people who are interested. And you're going to build a network of people who are interested. And then you're going to be able to cherry pick from it. And it's important to get outside of your comfort zone. If you're a business person and you're not used to you need to find people who are technologists. You're going to have to get outside your comfort zone. Maybe you go to a Ruby on Rails meetup and you sit in the back and you just listen, and a bunch of it's going to be gibberish, but you'll probably get some little pieces of it and you'll figure out who are the smart people. And maybe afterwards when you're having a cocktail, you can go up and say, hey, you know Mary, I heard you answer a couple of those questions. You seem really sharp. I Could you listen to my idea for 5 minutes and just give me a little feedback? Right? And you can engage with people like that and you start to build these networks. But you have to get out of your comfort zone if you're looking for someone who's not like you. And by the way, speaking of not like you, this is an opportunity to start early and have a diverse team.
Yeah.
I was on a call yesterday where we were talking about the value of diversity and trying to put some numbers to it, make it monetary. But it's hard, but it's very, very, very clear that when you're trying to recruit people, that the broader net you can cast, the more people you could possibly interview, the better team you're going to ultimately get. And if you end up having a very homogeneous team that's a bunch of people who look like you, then you can't cast a very broad net because people who don't look like them, don't feel comfortable, aren't going to feel comfortable in that environment.
Yeah.
But early on, if you can get diversity in your team, one, you'll be able to cast a broader net. But more importantly, too, is that you'll have diversity of perspective. And when I talk about diversity, I don't just mean gender and race and religion, but diversity of experience, right? Because your consumers, your customers are not all like you as the founder. And the more diversity of experience you have in decision making, I believe the better decisions you're going to make. And so this may mean, just like I said, getting out of your comfort zone and going to meetups at places with people who don't look like you. So if you are very much the business person, you may have to go spend time with the engineers. But it could also be people who don't look like you. You might go to if you are someone like me, I'm Caucasian, right? May go to a meetup that's in the city that's going to have a lot more people of color and a lot more diversity in that way, because you have to broaden your networks. And I can't stress enough how important I think diversity is in helping companies and helping organizations make better decisions, and have better financial outcomes. So this is the time to do it. The earlier you do it, the easier it is. It's really hard when you have a homogeneous team of 20 people to say, okay, now we're going to flip a switch and change our culture. Culture isn't something you have, it's a way you act.
Right.
And you have to act that way from day one. the way you act will attract certain people. Those people will mirror how you act and will reinforce it. And so if you act in a way that's homogeneous and monolithic, you're going to have that, and it's really hard to turn. But if you're more diverse from day one, you're going to have that culture.
Love that. Super important message. Definitely appreciate that. So let's say you're the business person. You're attending the back seat of a Ruby on Rails meetup. You meet the hypothetical Mary, and she's game. She's game to help tinker, help build, but she has a day job. How do you structure it? Because I know this is where a lot of problems come up, because there are sort of promises and miscommunication and a lack of experience about how to actually execute from here. What advice would you have for business person and Mary as they are thinking about building the early part of their company?
Yeah, so I'm actually helping a friend of a friend with this right now, and he has his day job. He just graduated from college. He's got a cool idea around music and the internet, and he's trying to put together. He had to grab a technologist. Now he's got a guy. He's like, I got someone to be my CFO. I'm like, CFO? You don't even have a company yet. Like, what's a CFO gonna do? Um, but he's putting together the team. And so what we talked about yesterday when we were talking about this was how important transparency was and expectations are. And at the risk of offending people, I'm going to make a dating analogy. So when two people are dating, if both people are really into each other, they're way up here, it works really well. Spend every waking minute together, right? They're like never separated. And by the way, if there are two people who are in a relationship who are like, this is kind of a casual relationship and they're down here in terms of intensity, we'll see each other once a week, whatever, that works really well too. When you have a relationship where one person is really into it and one person's kind of casual, that's when they fail.
Hmm.
And the same thing is true in business. And I use that analogy because it's usually visceral. People are like, oh yeah, I had one of those. That didn't work. I don't, whichever side you're on. But same thing is true in business. And so the advice that I gave this friend or friend of friend was make sure that your expectations of what each person's going to do on your team and their expectations are aligned. So in this case of this CFO for a very early company, they actually haven't incorporated yet. They're going to incorporate next week. So super early. Like, I think it's probably a 2-hour a week job, right? It's like pay a couple bills and at the end of the month, fill in QuickBooks and like, what are you going to do? And this CFO has a full-time job that he wasn't willing to leave anyway. So that can totally work. If you both sides say, hey, my expectation is it's a couple hours a week, here's what I want you to do. And commensurate with that, since I'm going to be putting in, 40 hours a week, that's what our return is going to be. So if I have 50% of the company, you should have probably 2.5. I made up those numbers, but you're putting in 120 at the time, you should have 120 at the equity. If you have that conversation up front, then and everybody agrees, it's so much easier. Where this fails is when the person coming in is like, yeah, I'm joining, I'm going to be the third co-founder, thinking I'm going to get a third of the company. And you're thinking, oh, they're going to work like a couple hours a week, they're going to get 1% of the company. That always fails. You have to have those conversations up front. And then I'd be remiss if I didn't say you all have to have founder agreements in writing. You don't need lawyers. It can be a single sheet of paper that you both agree and sign to, or all three, or however many you are, that talks about vesting of your ownership in the company, that talks about what happens if somebody leaves. Because inevitably, if two people start a company or three people start a company, one of them's probably going to have a change in life events and pull out. So if three people started the company and one of them leaves after 6 months and the company's a wild success 10 years later, should they each get a third of the profits? No. So how do you manage that? And we don't have the time to go into it today, but there are things called vesting agreements, and typically stock will vest over 48 months. You can choose longer, could be 5 years, could be 3 years, but you have to have those agreements. And if you build the agreements when you're all neutral, so the agreement is if one of us leaves, here's what happens. And you don't know if you're going to be the party who leaves or you're going to be the party who stays. You tend to build very fair agreements. Because you could be on either side of the situation. If you wait until someone's thinking of leaving, those become very difficult conversations to have, and they end up with conflict. So make sure that you have a founder. It can be simple writing, no lawyers, but what happens if somebody leaves? What happens if somebody goes and takes a full-time job but still contributes? What if they're part-time? What if they're, you have to think through some of this stuff. And what you're trying to do is align interests, because as long as you keep your interests aligned, again, you can both be really intense, you can both be here, both be in the middle, you're going to do great. It's when you get out of line that you
Yeah.
have conflict.
At what point should you get a lawyer though? Certainly at some point it makes sense. Where is that line in your mind?
Yeah, at the point that you start putting in real money. So at the point at which, and real money is different for everybody, but at the point where you're investing real money in real time. So if you're giving up your day job, or you're putting a couple $1,000s in, or you're going to have to do some stuff. You're going to create an entity. You're going to want to have a founders agreement. You're going to want to have vesting. If you do, depending on how you build it, you got to do this crazy thing called an 83B election. Go look that up if you're starting a company, 83B election restricted stock. Because if you mess that up, you only have a 30-day window to do it. It's an agreement with the IRS. You can never undo it. It's really hard. But so lawyers can help you navigate some of the legal structure. What's more important to me at this early stage is that the founders are seeing eye to eye. They have a meeting of the minds, and they all agree. In my very first company, when I brought on, I told you I doubled in the first year. I brought in a partner, Ed, and when Ed started, someone gave us the suggestion that we have a little founders agreement, and we did. It was one sheet of paper. We had no idea what we were doing. But I had worked for like 6 months with no salary, and now he was coming in and he wanted to be kind of an equal partner, and said, okay, he'll work for 6 months without salary while I get paid. Like he'll have, that's how he'll pay in. And we specified what happens if the company gets sold at some point. And we had some concept of vesting. It wasn't very fancy. It all fit on one sheet of typewritten paper, and we signed it. And when we sold the company 6 years later, we went to the sheet of paper and said, what does this say about how we split things up? And we split them up, and I think it was 55-45 or whatever it was. Realistically, and I would say this in front of Ed, he may listen to this. So, when it comes to who built the company, like I was the CEO, I was the one who was leading the company, hiring the people, getting the clients, doing all that stuff. Ed is an amazing individual contributor. He's still a good friend today, but he really liked to sit and code and solve a problem. And so if you tried to value who built the company, I did 10 times the company building that he did. But we had agreed it was going to be 55-45. We looked at the paper. We said, this is how it is. There was no debate. There was no argument. There are no hard feelings. And that's how we split it.
Yeah.
And that was fair, because that's what we agreed to. Had we not had that piece of paper, trying to value, like, what was your contribution to this company? What was my like, that would have been an ugly, ugly thing. It's almost like a prenup for a marriage.
Right. Yeah. So then let's say you got something built. You have some signs of growth. You've done all the validation, lean startup, and you think you have something. How do you think about fundraising, approaching venture capitalists? How do you incorporate accelerators into that thinking? I know it's a huge conversation, but I'm curious just thematically how you help advise teams through that.
Yeah. So let's go up to 40,000 feet. At 40,000 feet, so there are certain stages that most companies go through. Not every company goes through every stage, and I'm talking about fundraising. You can skip stages sometimes. So initially, you usually self-fund it. So that means if you have savings, if you have credit cards, etc. For some people, that might be a couple $100. I've seen founders who've self-funded things with hundreds of thousands of dollars. They had a successful exit before. I'm self-funding it. Everybody is different, but it's self-funding. The next stage is generally friends and family. And that's when, I've got something, I'm really interested, I need a little more capital to get this thing going. And you go talk to people who you know and try to raise a little bit of money from it. Again, friends and family could be people writing you a couple $100 checks. It could be thousands of dollar checks. It could be everybody's friends are different, have different amounts of wealth and risk. With friends and family, it's generally people who are betting on you. They may not even understand the business. They don't understand the structure, but they're betting on you. And they're like, I know this person. She's awesome. I'm willing to invest in her. I have faith in her. Please be careful if you take friends and family money, that let them know this is super risky. The odds are it's not going to be worth anything. Don't take money that you think people can't afford to lose.
Right.
But that's friends and family. The next stage is angels. Angel investing is people who are generally sophisticated investors. They've done this many times, but they're investing their own money. When they're investing their own money, they can make investments for any reason they want. They could like the color of your shirt and decide to invest. They could really like the space you're in. When I was doing angel investments, there were 2 companies that I really thought this thing should exist. I don't know that I'll make any money on it, but I want to help it exist, because if it is a shot of being in the world will be a better place. I'm going to invest a small amount of money in it.
Yeah.
It's my money. I can do that.
Sure.
Right? That's angel. And then the last category we'll talk about is venture capital. And this is professional investors who are investing other people's money. So Math Venture Partners, we actually went out and raised money from a bunch of other people, and we have a pool of money like a mutual fund that we then invest in companies. And we have a specific mission. We're investing in digital technology companies, early stage, et cetera. Just like if you invest in a mutual fund, it'll be for a specific purpose. But I'm investing other people's money. I can't invest Math Venture Partners money because I like the color of your shirt. I can't invest it because I just want this thing to exist. My mandate is to return more money to them than they gave to me. They did it for a financial investment. So once you understand that, and again, you don't have to go through every phase. So sure, payroll, we put up our own money, and then we went straight to venture capital money. We decided this was risky. We didn't want to take friends and family money. We only wanted professional money. Usually there are more steps in there. But you have to decide what risk you're comfortable with, and you have to understand the investor on the other side, why they're investing. And that's why I make the joke about the angels and the color of your shirt. Like, it's more about the relation, as much about the relationship as it is the business model. Many times they'll want to be like, oh, that sounds like a cool idea. Can I help you? Like, they want to mentor, they want to help, they want to roll up their sleeves. Some angels don't, but you have to understand the reason the investor is investing. When you get to VCs, there's only one reason they're investing. And that's because they expect to get more money in return, and they expect to do it at a low risk. The lower the risk, the better. I have a little video on the Math website that I call the pot of gold. And I think that the best pitches are ones where you talk about the problem and solution for a very small part of time. That's easy. And then you have to show the investor, the professional investor, this is how big the company's going to be worth. This is the pot of gold, how much it's going to be worth. And then show them a low risk path to getting there. And you spend all of your time on that low risk path to getting there. Like 60% of the pitch is all about the mechanisms. Like, because if they believe this is going to be worth a lot of money and it's a low risk path to a lot of money, they're going to write you a check. Like, right? Yet so many entrepreneurs totally miss that and spend all their time. They spend 95% of the time talking about problem and solution. I want to show you the cool feature I built, problem, solution. But investors aren't investing in a solution. They're investing to make money. So you've got to show them, how much am I going to make and how much risk is there?
Yeah.
It's that simple. But so many people miss that.
So you and I co-wrote a article series on financial modeling, and this is something you and I both hark on. And I remember watching your lecture in one of your classes on it, and then just my jaw dropped to the floor, and I just was curious why all founders didn't do this. Maybe can you take just a couple minutes and explain why this is so important, and even at the early stages, why founders should be putting together a financial model?
Yeah. So financial modeling, and I continue to do these talks. I give it 30 or 40 times a year now, a lot through Zoom to Techstars cohorts, and I do it at Kellogg, and I did one to a group in Tel Aviv last week. I mean, all over the world. So here's what I think about financial modeling. A financial model is a mathematical representation of the inner workings of your business. It's not a set of projections. The projections are an output from the model. And if you have a mathematical representation of how your business works, you can do simulation. It's sort of like a flight simulator for a pilot. Imagine if pilots didn't have flight simulators and they had to just get behind the wheel of a jet plane and hit go and like, let's see what happens, right? And they crash. That's really expensive. You die, right? But with a flight simulator, which they spend hours and hours and hours in, they kind of learn how the plane performs and what happens if I go into a nosedive and what happens if I do all this stuff. And then they take that and they apply that in the real world. And the financial model is very similar to that. You're trying to build a flight simulator for your business. If I spend more in marketing, how many more customers do I get? What did that cost me? How much more do I need in customer service? All of the mathematical inner workings. And if you've got that, then in Excel, You can play with your flight simulator, see what levers work, what levers don't. Oh, it turns out putting money in this doesn't have any impact. I shouldn't do that. Oh, there's a lot of impact if I can change my conversion rate on web visits, right? And you figure out what are the variables that matter, what are the drivers and sub-drivers of your business, so that when you get behind the wheel of the real business, when you're operating the real business, you can start to collect real data about how it's performing, put it into your model gets more accurate, and it has a better ability of predicting the future. Because if it now knows what all those conversion rates are and what the levers are and how much you're spending, and it actually gets, especially when you have large volumes of transactions, if you're B2B enterprise where you make like one sale every 6 months, it's hard to predict the future because it's very lumpy. But if you're either Sure Payroll, which was B2B, but we had lots of little transactions, right? Lots of customers who paid us $100 a month, or if you're B2C with large volumes, it is amazing how accurately you can see the future. And it really is like having a crystal ball and seeing the future if you have a really good financial model. I'm guessing, Will, you'll post some links to the series up there.
Yeah.
And I've updated, I should probably give you, I have an updated deck and some updated model Excel sheets that just are a little cleaner. And if you do this well, it totally reduces the amount of risk there is in the business. And so when I see a new business, the first thing I do is start making a model of it. And sometimes it's a simple model, right? So if it's just an idea, you may have a spreadsheet that has like, half a dozen rows and 10 columns, and you're just kind of like, what's it take to get to cash flow break even? How many sales do I need? Okay, not very sophisticated, took you 20 minutes, but you like now have an idea of what the first step is in your journey as you go through these plateaus. And then if you start executing and you're like, oh, I think I know what this is going to feel like let's map out the next part of the journey. What does it look like with a little more resolution and granularity? By the time you're actually operating a business, raising money from venture capitals, you have a financial model that has, 10, 15, 20 tabs, has historical data, future looking data, and it's super accurate. You can see what actually happened, what's going to happen. It is one of the most powerful tools I know to predict what is eventually going to happen in your business. And that is power. That is knowledge that will make you more powerful, because you can decide where to put your time and where to put your money.
So playing the startup game, then playing the venture capital game, then coming back and playing the startup game, what did you notice, or what did you do differently starting up Ivy? Like what sort of things did you learn from your past that definitely carried forward as you were now starting this new venture?
Yeah, it was really good. I think the thing that I started seeing as an angel investor and Graphene was kind of like the macro view of what is the business that you're building. Like in the first 15 years of my career, right, it was about taking existing businesses or taking mid-sized businesses and kind of growing them. But when you looked at it from an angel investor or a venture capitalist firm, it was like, what's the macro story, right? And started thinking macro and then going micro. That was one thing that helped. The other part was like sitting on the side of the table as an investor. There were certain key things that you were looking at, from founding team, problem being solved, route to market, and then the cap table. That part I wasn't as familiar with prior to that. That helped a lot in kind of like helping me ideate. I got some good, like for example, I got some good feedback from another venture capitalist that said, take 6 months before you write your first line of code. Right? And basically saying like, do all the customer development, right? The research, use tools that are really efficient to create what is the product and testing out the product before you go out and like just kind of do a whole bunch of keystrokes off of it. And if for nothing else, right? There's a big value in being capital efficient and doing that way. Engineers are expensive, right? And if you're not writing the right thing, you're capital inefficient. Those are some of them at the beginning. At the later stage, I would say when I went to raise money, okay, I knew how to target better, right? I knew who really invests in what they say they invest in, and I knew like who to call, who not to call, who not to waste time with.
Yeah.
I think one thing I heard from a founder was like, they wish in their seed round, they didn't reach out to 300 people, right? Like there's just somewhere where you just target better, and then so that's been helpful. Yeah, and I can go on to more. There's other stuff around once you raise money or when you're about to raise money, like how to structure that. But
Well, let's talk a little bit more about that targeting, because a lot of founders listening in are in the process of raising money or just curious about how the process works. And there is definitely a advice, cultural tide standard amongst founders to go reach out to those 300 investors, and it's just everybody says you're going to get 1,000 no's or whatever, and just you got to get expected to hear no, 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 but it's a numbers game, and that is the common mentality out there. How I'm intrigued by what you're saying here, and I think I generally agree. How would you advise founders to think about the targeting?
Yeah, I got the same piece of advice that seed round, you're gonna need 100, 100 touches, 100 people that you reach out to, and you hope to get about 5, right? So that 95% rejection rate, I don't think a lot of people are built for it. I don't think that number is inaccurate. I think the thing to think about is just kind of like it doesn't need to be 300, right? Or the process to find the right person at those firms. That's some of the stuff I would do about targeting. But before I talk to you about the targeting part, though, like maybe some higher level stuff around like dispelling some things about raising money, right? And like venture funding is not the panacea, right? And so a few things to kind of think about is like it really needs to be a massive business, right? Like I think 5 years to be $100 million business. Okay, can that really be possible? Can it be $1 billion opportunity? Like really ask yourself if that's the business you're building. And if not, then VC might not be the right route. And that's okay, right? That is not the majority of the way people get financed. So I think about that first. I think about the capital. Second thing I think about is like capital is very competitive, right? Like you're going up not against people in your industry, but the thousands of other companies that are pitching those same companies. So be prepared to be competitive. Like why are you exceptional? Why is your firm exceptional? VCs are, third thing I'd say is VCs are much more risk averse than you think.
Yeah.
I think everyone's like, oh, they're risk capital investors, but at the end of the day, they're still investors. So they're risk averse. Fourth thing, psychology to selling. Like there's a way to sell, like this FOMO thing, right? Like it is a thing. Like your lead, we'll wait for a lead investor. Okay. Or this lead investor needs to have this, or doing a group round. And the last thing is VCs are not ... You fill in the blank. And there's a lot of things in there, right? That I mean, like, they're not domain experts, right? They're not so contrarian, right? And I don't mean everybody, right? There are top players in any field, and then there's others. And those others are an associate that's just coming on, a mid-level partner that's feeling themselves out, right? So what I say with that is, don't think that someone's feedback, the 95% that say no, it doesn't mean that your business is bad, right? So, okay, with that in mind, I like targeting. Certainly domain expert and stage I'd filter by, make sure that's right. Then I'd filter by the right person at that firm, and that part is a little tougher, right? Like, oh, you're going into Sequoia. Okay, maybe it's too early, but if you went into Sequoia, who at Sequoia do you go into? Some founders that do this really well, John Rinaldi, I'll call him out from GeoBit. He did this really well. He'd go through and say, here's my target list of companies and specifically these people. And then who do you know? And he'd gather from his investor base or his friends or refer a founder network. Who do you know? And then he'd take the best intro to get into them. So like, it's kind of like that 3-tier filtering. And then I don't know how you do this aside from like just kind of researching. There are people that say they are ex-investors, and then there are people that actually are those investors.
Right.
Right? Oh yeah, we do early stage all the time. No, you don't. Like we invest in great teams. No, actually, everything you've invested in is a product that's gone out to market. Right? So I don't know how you do that well, Will, but you muscle memory of reading through, either their blog posts or stuff that they do online, and then founder networks. Founders will tell you who's really additive. I mean, they're the best source of truth.
Yeah. So for you then starting Ivy, what did those early validation journey look like for you? Like how did you know that this was something that you're going to continue to invest your time and money and rally investors and team behind? How did you go through that that gauntlet?
Lots of mistakes. I mean, like product experiments that failed, approaches that were totally wrong, right? And then you just kind of keep going. And
Yeah.
the first thing we started thinking about, I was really inspired by Toyota has a really Toyota at CES in 2018 put out this e-pallet concept, and it's really wonderful, right? It's this electric vehicle that it looks like a skateboard, and on top of it you put a parcel that looks like a vehicle, but actually looks like any form factor you can put on. So they have a vision of, you know, a restaurant on wheels, a retail shoe store on wheels, an office on wheels. And they have this thing where like the e-pallet will put on these different form functions onto the pallet and deliver that experience out to people. I was amazed by that. You know, your coffee shop will arrive in the morning. On your way home, your spa will take you home. You know, and the vehicle will become a third space. Like that was just mind blowing. So for product, we went out and got a fleet of vehicles and started putting things into the vehicle that were both digital and physical to test out what resonated, thinking that we could get a really high price per ride for that experience, starting to build the experience layer holistically into the vehicle. And what we found was that the market pricing for that from either passengers or brands, that wasn't at the price point we wanted. Like we had done consumer research digitally, and they had said, well, 35% said they'd be willing to pay more for this type of ride. It's great. And the price point was not where we needed it to be. Okay, cool. Now what do you do? Feedback from a founder was, look, this is kind of humbling, but do the simplest thing you could do that could scale, even if it's really not your end product. That's tough as a product builder to be like, oh, you know that it's a level 6 experience when you want to deliver a level 11, right? Like that gap led us to just start with the tablet in the vehicle, create a digital experience that can be dynamic, and then you can do things that can scale up with bigger players.
All right, a couple quick things before you go. Number one, I have a general newsletter where I write about technology and startups and health science and teaching people to code. And I write about a variety of different subjects that we talk about on this show. So if you go to wclittle.com, there you'll be able to subscribe, and you'll also be able to subscribe to particular topics. If you're just interested in one or a few of them, you'll be notified right when I publish new content in those areas. Number two, my partners and I at Proto Ventures have a portfolio company called Startup Rocket. If you go to startuprocket.com, there you'll be able to receive coaching guides and customize an operations framework for you and your team and your advisors to be on the same page in terms of what is the appropriate next step for you in your entrepreneurial journey. And finally, if you wouldn't mind leaving a review anywhere that you have listened to this podcast or watched this podcast, it would be super helpful to help those who might be interested in consuming this content as well. Thank you.